Hello again and welcome back. Thanks for tuning in this week. Now, a couple of Canadian institutions has pretty much confirmed this here home buying recipe and the future outlook for it, and it looks good for anyone that's been following. But before I get into that, let's get into the statistics for October from the Canadian Real Estate Association. All right, from CREA, Canadian home sales see surprise jump in October. Home sales activity recorded over Canadian MLS systems increased 7.7% on a month-over-month basis in October 2024, reaching its highest level since April 2022. Quick, everybody, get out there and buy. The sales are going through the roof. You better get in now before it's too late. Not so quick. Let's dissect this data and see what really happened. So here are the October sales dating back to 2007, and the red one there is 2024, obviously, and we are actually right on average. So this has been an average October. So again, not through the roof, the sales, but it has been an average one. Of course, better than the last 2 years and not nearly as good as 2020 and 2021. Now, months of supply did subside. It's down to 3.7. We were at 4.1 there for a while, but it has gone down. A lot of sales has taken the inventory away. So, of course, that did subside a bit, but still pretty healthy considering where we were at again in 2020 and 2021. Here's the long-term trend for all months, for the months of inventory. And you can see, we took a dive down, of course, not nearly as low as we were back at the lows there in 2022. But it was a big month for sales. So, of course, that inventory did get eaten up a bit. And here is the correlation between the average sales price and the months of supply or months of inventory. And you can see in the red there, as months of inventory dropped to 3.7, the sales price increased, which supply and demand, right, makes sense. But yeah, directly correlated. And that's why if you watched, I've been calling for about 4.5 months to really start to affect the prices to the downside. Now here is the sales to new listings ratio. It's sitting at 58% for October. All the red lines there, the red bars, are the Octobers going back to 2019. This is as far as the data goes back with CREA, and every other month in between. So please note there that January this year was the other month that was near 58%. I think it was 57.9. And every other month, of course, didn't reach that because we had extra inventory this year. But look at the last 5 years. Every one of them reached significantly higher than 58%. So it seemed like it took a big jump this year. But again, it is the lowest year of the 5 years that they have tracked here. Now into the average price. So the average price for October was $696,000. That's 3.9% increase month over month, or $26,000. That's a big chunk for a 1 month jump. 6.3% year over year from last October, or $41,000, and still down 14.6% from the February 2022 peak, I should say, or $119,000. Now let's just look a little further into this data here to compare it to other years. So our high for this year, we're currently at 696. Our high was April at 703 and change. Last year, 2023, the high for the year was 727. 2022 was February at 815,000, and even in 2021 there was a couple of highs there, but November had it just by a bit, 717,000. So out of the last 4 years, we're currently sitting at the lowest high for prices. So again, when you hear prices are going up, you better buy now, because we're hearing some of that FOMO again. Be careful, because when you put it into perspective, we're actually the lowest high of the last 4 years. So be careful out there. And of course, I've been tracking this one, the pennant. I say it's a bearish pennant. I put them both on there. Continuation pattern there. And we bounced right off the top. We'll see what November brings. Will it break through a bit and put this pattern to shame, or obsolete, I should say. But we'll see what happens. But it looks like it's forming there, that perfect pennant, if November takes a drop. And of course, December and January usually always take a decline or take a drop in prices. So that'll be filling in the end of that point pretty good there. But yeah, we'll keep an eye on that. And here is the monthly mortgage payment on the average Canadian home, calculated using the national average price with 20% down and prime rate. Actually use prime minus 1% to make it a more accurate reflection of prices of a mortgage payment. But we're currently sitting at $3,240, and of course I put plus there, plus property taxes, plus maintenance, plus all the rest of the stuff owning a home, of course. when comparing that to the rent price. Now, the rent price, unexpected to me, I thought the rent price would keep increasing maybe to $2,500 and the mortgage payment would come down, but meet in the middle somewhere around $2,500 at some point, maybe years in the future, but not now. Rent price is declining and so is the mortgage payment, of course, because interest rates primarily at this point, but house prices will help that accelerate to the downside in the near future, I'm sure. But again, $3,240 plus all those things of owning a home, and $2,152 to rent a home. So $1,000 difference, actually more if you consider all that property tax and all those extra things, maintenance and things that you have owning a house. Okay, now let's get into those two recent articles I've been talking about that's pretty much going to confirm this home buying recipe right here. So let's start off with the CMHC article. Okay, so here it is from CMHC, the analysis of the Canadian residential mortgage market. And this was just from last week, November 14th. And I'm going to read some key points here. Despite the resilience of many homeowners, mortgage arrears are expected to continue rising in the short term, with Toronto and Vancouver facing the highest risks. Data indicates that financial pressures may persist for some time, impacting these key markets. The head of the Canadian banking regulator recently said he was pleasantly surprised by how well Canadians managed mortgage payment increases. This was echoed by others in the financial sector who also noted the resilience of Canadian homeowners. This resilience will be needed over the next 24 months as they continue to navigate the impact of higher interest rates and economic uncertainty when they renew their mortgages. Now, there's two main findings from this report of this study. And the first one, the health of the resale housing market plays a critical role in predicting mortgage arrears. When sales activity slows, signaling a cooling market, homeowners struggling with their mortgage payments have fewer options to sell and avoid falling into arrears. The sales to new listings ratio is an important indicator of mortgage arrears. We normally see a decline in sales to new listings ratio 6 to 12 months prior to an increase in arrears. So now back to the sales to new listings ratio chart here that I just showed you, and you can clearly see the sales to new listings ratio has declined from all years, actually shown on this chart here. It hasn't been lower by average or by the highest peak than any of those other 5 years, as I previously pointed out. So it is safe to say we have seen a decline in the sales to new listings ratio. All right, now back to this article. Arrears in non-mortgage credit products such as credit cards and auto loans are an early predictor of mortgage arrears. Initially, there is a negative correlation between non-mortgage and mortgage arrears when observed with an 18-month lag. This suggests that when financial pressures begin, homeowners often prioritize keeping up with their mortgage payments at the expense of other debts, which obviously makes sense. Keep your house, get rid of everything else. However, within 6 to 12 months, early signs of trouble in non-mortgage debt are generally related to increased mortgage arrears. So you hear a lot about lag time because they're looking at early predictors of what's coming in the future. But of course, these indicators are historically proven and we're seeing these now. We're actually in the lag time period right now. So now I really like the way they break this down. A tale of 3 stories. 3 distinct groups of cities emerge from our analysis. Housing markets that may not go through a sharp increase in mortgage arrears. Housing markets that may go through a sharp increase in mortgage arrears. A mixed group that deserves further monitoring. Now, in the first group, you have Calgary, Saskatoon, and Halifax. Mortgage arrears in these cities are expected to remain close to their low post-COVID levels. We expect relative stability in their mortgage arrears rates over the next few months. Next, on to Winnipeg. Also appears stable, though recent trends show a sharp decline in average credit scores and an increase in non-mortgage credit arrears, which could signal upward pressure on mortgage arrears in the future. And then you have Toronto and Vancouver, 2 of the most populated areas in Canada. I know Quebec's up there too, or Montreal, but Toronto and Vancouver are in a completely different situation, and arrears are expected to increase in these cities. Our modeling shows Toronto may reach mortgage arrears rates unseen since 2012. While arrears rates are not expected to rise as much in Vancouver, they could reach levels like 2015. The high number of listings relative to sales in Toronto and Vancouver is likely limiting the exit strategies for current homeowners seeking to sell their unit, diminishing market fluidity. This, combined with increasing non-mortgage arrears, creates conditions likely to result in increasing mortgage arrears in the future. This could potentially be avoided if mortgage rates decrease more than expected or if market conditions, as measured by the sales to new listings ratio, revert into seller's market territory where there are significantly more buyers than sellers. And then you have Montreal, Ottawa, and Edmonton showing mixed results. So they included a chart here for mortgage delinquency rates, and this is a forecast Q3 to 2025 Q4. And yeah, look at their Toronto. Toronto's that line, the dotted line going up there, and it's rising sharply or forecasted to rise sharply. Every other one is also expected to rise, not nearly as much as Toronto, except for the one there in the orange. I think it's Montreal. What to expect next? When interest rates started rising in 2022, many experts cautioned that the full impact of monetary tightening would not be felt for 18 to 24 months. And they go on, talk about the burden of mortgage shock, a few other reports there. I'm going to get into the one from RBC next, but they finish off by saying, even if Canadians continue to draw on the remarkable housing resilience, significant risks still lie ahead in this uncertain economic environment. Now on to the RBC report. This report just came out October 16th there, and they talk about proof point. Job market is bigger risk to Canada's economy than mortgage renewals. In the midst of a historic interest rate hiking cycle over 2021 to 2023, I thought the rate hiking cycle started in 2022, but anyway, maybe they're talking about mortgage rates, but it wasn't 2021. A persistent concern has been that a mortgage renewal cliff would derail the Canadian consumer and broader economy along with it. Now, this isn't a long article, so stick with me. While these mortgage renewals will certainly act as a brake on the economy as a whole, we made a point as far back as almost a year ago that 2025's mortgage renewal wave would be manageable as long as, 1, the Bank of Canada was cutting rates, and 2, the job market doesn't soften too much. The first condition has clearly been met, but we are more concerned about the second as a slew of labor market data continues to weaken. And they get into some data there with bond yields and the mortgage market and whatnot. More concerned about possible labor market weakness. Higher mortgage payments certainly hurt the total amount of income available in the economy to spend, but higher unemployment does as well. We anticipate a 1 percentage point rise in unemployment rate typically lowers household disposable income in the economy by 0.5%. Our forecast calls for continued modest rises in Canada's unemployment rate from its low of 5% in mid-2022 to 7% by early 2025. That's a significant increase and more than a percentage point above pre-pandemic levels, but we're watching for deterioration that might extend beyond that. And here's a chart which they're going to talk about right now, but of course you see the job openings, both the Indeed and the job openings, SEPH, both are down. So job openings are down, which means they're going to forecast a rising unemployment because there's less jobs available for people. And it's a leading indicator of unemployment, and this is what they talk about right here. The total amount of job openings in the economy is 25% below where it was a year ago, and if it weakens further, it will cause the unemployment rate to rise more than our base case. Now, their base case was 7%, so they're saying if it weakens further, it's going higher than 7%. Initially, there were more job vacancies than people looking for work, so the drop in openings didn't have a material impact on the economy, but that's no longer the case. The unemployment rate is now above pre-pandemic levels, and the job vacancy rate is lower. Any further drop in hiring demand raises the risk of unemployment rate rising more. So wow, we have two major institutions in Canada, CMHC and Royal Bank of Canada, forecasting both higher mortgage arrears and higher unemployment. Again, all part of what makes up this home buying recipe, and forecasting it's going to happen obviously in 2025 at this point. Now, when I made my forecast, it was made with historical trends, interest rates, of course, all the things that are tied into it. RBC and CMHC are now making their forecast based on current trends. So we have historical trends that are now confirmed with current trends. And again, this is not a maybe. They're like forecasting it's going to rise, unemployment's going to rise, delinquency is going to rise. They don't know by how much, but they have a base case, which again puts these indicators, these battery bars, they're going to be filling up pretty quick. Let me know what you think in the comments. And of course, stay tuned as we'll be tracking this. That's all for this week, and I'll see you next time.